Good morning, everyone. Allow me to share the screen, and our today's topic will be on trust accounts. In our previous class, we looked at the classification of trust, and we also said that basically trust is an equitable obligation which binds now the trustee to deal with the property of the owner. And we said that this is to happen including what he or she has control over. So the owner could also be the trustee. Then we went through the classification. We gave the express and the ones that operate under the ones that are operationalized by law. And that is according to the Trustee Act, Cap 167 of the laws of Kenya. And we say that this person has been given a lot of trust, especially if they are playing the role of the owner. They are not the owner themselves. We went ahead and even gave the process or how the appointment of trustee is done. And we say that we have to look at the capacity, and particularly the person who is supposed to be a trustee is not supposed to be disabled, is not supposed to be residing abroad, and we also say that he is also not supposed to be a beneficiary or the attorneys or the solicitors of the beneficiary or their spouses. And the very reason why we are doing this is to try and eliminate the conflict of interest that might arise. We went ahead and talked of the numbers, and we say that the ceiling is 4 for a private trust, and the floor is 2. So a maximum of 4, a minimum of 2. But for a trust corporation, we have now the board, or we have the people who've been identified to go ahead and run the trustee in case of a trust corporation. And a good example of a trust corporation is the charitable organizations. And we know that the interest and the stake is very high. That is why we are talking of more than a sole trustee, or to ensure that the decision that is arrived at is a collective decision and not by one individual. So the reason why we are having this trustee, the trustee is someone the owner has vested a lot of interest in their properties to go ahead and administrate or take care of their properties as if they are the owners. And our focus today will be on the investment, or that power of investment. So the trustees have a duty to obtain control of trust assets and to invest trust funds in authorized securities. So when we are talking of this investment, we should not now forget the bookkeeping. And that's why we are looking at the trust accounts today. Trust accounts, because we want really to understand how the property of the owner is being administered. So I want us to look at the trust accounts. And the reason for doing this is to demonstrate how the trust funds are recorded, or how the accounts are prepared in accordance with the trust instrument, or also to appreciate or be able to explain the transactions of the trustees to the interested parties or the beneficiaries. So accountability of these accounts is very imperative. And therefore, all the properties of the particular trust, whether they are in the hands of this particular trustee or they are elsewhere, they could also be foreign property. They should be brought or they should be disclosed. And the reason for disclosure is to help us understand how or the net worth of this particular trust. And we may list them into two. We have what we call the income items and we have the capital items. So in many trusts, different persons are entitled to income and the capital. And therefore, this necessitates a careful distinction between the two. Then we'll be looking at the form of the accounts. And basically what happens in the trust accounts, they are pro forma accounts. And by pro forma, I mean they are produced as a matter of form. Reason being, we want them to be as simple as possible. They can even be understood by someone who didn't go for an accounting class. So by the start, we need to understand the history of the trust. And by the history, we need to be polished with the summary of the will or the trust deed or the document that is guiding this particular trust. Then we need to have a short history of the trust. How was it formed or what was the owner's objectivity, right? We need to really understand, did the owner need the property to be under the trust so that when they are deceased, the property is not being misused or mismanaged, and it passes over to the beneficiary in a right manner. That will be shown in the history. Then we'll need to know the trustees' names and the addresses, and the reason for this is traceability. Shall it happen that the owner of the property is no longer there? We really need to understand or know where the trustees are to start the process or to understand how the property of the deceased is being administered. Then, very important is the name and the addresses of the beneficiaries. Now, present and future, they'll be very important with the date of birth, marriage, and death and relationship to the settler. And the reason is we really need to know whether we have any beneficiary who is not up to age. And we know that the majority age in Kenya is 18 years. So someone who is below 18 years is presumed to be a minor. And in that case, we should be having someone who is taking care of their interest. Then very important are the accounting dates. And the accounting dates will help now determine, or the reason why we want to know the accounting dates. In determining the accounting date of the trust, we'll be able to consider the date of death, and we'll be looking particularly at the anniversary of the death of the deceased. If, for example, they died on 2nd November, we'll be knowing that one calendar year will be ending 1st November of 2021. Then we'll need to know the fiscal year of this particular trust. The fiscal year runs from 1st January to 31st December, and the reason is because of the investment. If some of the investment are with the government, we know that the government fiscal year runs from 1st January to 31st December. Then we'll need to know the due dates of the payments of any annuities. If we have, for example, the settler was servicing a mortgage, and there is some premium that need to be paid at a particular date, we need to be knowing, because as the trustee, this is part of the duty that we are supposed to be holding. Then we'll need to know the beneficiary's income requirements, and we'll be knowing this particularly, we'll be having the categorization. We have the special range, we have the wider range, and we have the what we call the fixed interest rates. Then the content of the accounts or the major accounts that you'll be looking at, and I say that this will be pro forma accounts. They are produced as a matter of form. We'll be looking at the balance sheet, we'll be looking at the capital account, the income account, and the schedules and subsidiary accounts, explaining where appropriate the items in that particular order, the number 1 to number 3. And in the balance sheet of the trust, the group of the items in the balance sheet should be grouped under appropriate headings. In particular, a trust operating the provisions of the Trustee Act will have the fixed interest securities funds, we have the wider range securities and fund, and you have the special range securities and fund. So those are the sub areas that the items will be listed and clearly distinguished in the balance sheet. Then, of course, we'll be having the comparative figures, and for the comparative figures, we'll be talking about what the beneficiary or each particular beneficiary is supposed to take or command. So not necessarily that we are doing this for purposes of winding up, but we are doing this for purposes of even the going concern. We need now the trustee to continue administrating this property until when they'll get the information on what is in the will is achieved. Then in the capital accounts, where we are being guided by the Cap 167, the capital account will be divided between the fixed interest, the wider range, and the special range. And the balance on the capital account will be showing the total book value of the capital funds. Then the liabilities will be now on the particular item, whether the capital account or the income account. So we'll be able to distinguish which expenditure or which liability is hitting which account. Is it capital or is it income in nature? Then on the assets and the classification, we'll be looking at how the investments are classified in the balance sheet. And we say that our balance sheet will have the various listings. So where the Trust Act has been applied, all the investment will be clearly allocated to the appropriate funds. And unauthorized investments, because the trustees are allowed to invest and act as if the trustee is a fiduciary officer of the owner. So in some instances, they may go for an authorized investment. And where this is held under power of postponement, then it should be separated. We should be able to see the investment, the book value of the investment devolving on trustees in the probate value. And when I talk of the probate value, this is the value at the time of the death of the settler. Then part of a gift by a living settler, and this will be valued at the prevailing market value as at the date of gift. So if there are those gifts that were inter vivos or they were given at the life of the settler, then they should be reflecting as at the market value on the date of gift. And then any purchased items that were purchased by the trustee will be going by the what we call the historical cost value. So the cost of acquisition is what will be reflecting as the book value of that particular investment. Could be, let's say, the trustee deem it fit to go and acquire some apartments, let's say at Lavington. If the apartments were going for, let's say, 800 million, then we should expect that that will be the on cost, or that will be the historical cost of acquisition. Then on the revaluation of investment, we normally take place, or what normally took place is now to know what guided the trustee, both in application and both in the distribution. because the revaluation of investment, this is where the conflict of interest might arise. You might find the property that you said we've acquired at 800 million in Lavington, because of the service charges, maintenance, among other things. We could end up devaluing that property instead of it being valued at a higher cost. So we really need to know where the trustee decide to apply the Cap 167, or the Trustee Act, and where they decide now to distribute to the beneficiary under the trust instrument or what is appearing in the will. And then the cash and the bank balances should be distinguished. And you say this will appear either in the income or in the capital account. Let's start with the income account. And we are talking of the pro forma. Let's talk of the income account. So we are talking of the income account. And in the income account, the classification are basically under 4 headings. So we'll be talking of the rent. We'll be talking of the, if it is rent receivable, it is an income. If it is rent payable, it will be an expense. Then we'll be talking of the interest on government securities. That is an income item. Any dividends that will be declared. And we'll also be looking at the interest on mortgages. Then we'll have the taxation and income in the income account of the trustees or the trust account is stated as gross. And as gross, I mean before tax has been charged on it. So the provision for the total liability of tax should be shown as a charge against total income. And the reason we are doing this, we want to show the income that we really received versus the expenditure item that went to pay the tax liability. So when income is received net of withholding tax, for accounting purposes, the income is grossed by and tax is shown as a prepayment. And you know that prepayments are asset in nature. Then when we talk of the accruals, we normally, in Kenya, we normally say that income should be accrued to the balance sheet. But we understand that the golden rule is that income is not provided for until it is actually received. But in Kenya, we apply what we call the accrual basis. If you go in countries like America, both income and expenditure are accrued in accordance with the generally accepted accounting principles. In the UK and most of our accounting practices, the best practices are borrowed in UK. The expenditure is accrued in accordance with the accruals concept, but income is recorded when it is received. And we are doing this as a matter of prudence. And you know, prudence concept says that we are not supposed to overstate or understate our income. So in the Kenyan sector, in our trusts, we normally take income as an accrual, and this is reflected on the balance sheet. And we know that accruals are liabilities. Then we have the statutory apportionments. Now, investment should be maintained at the probate value, and I said probate value is the value as at the time of the death of the settler. Well, so a transfer should be made to the estate account to restore the investment to probate value before we do anything. That's what we are calling the statutory apportionment. Now, under the trustee, we have the authorized investments. Now, these are the investments which trustees are permitted to hold, maybe specifically stated in the will or the trust deed. And these now constitute the settlement. So where the will or the trust deed is silent on the matter, the authorized investments are as provided by the statute or the Cap 167 of the Trust Act. So the trustee lays down the scope of trustees' investment, but has also to introduce the safeguards to ensure that they prevent excessive losses to the trust funds from unsuitable investment. Remember, a trustee is a fiduciary officer of the settler. So they should act in a manner that will always ensure that they don't incur excessive losses. When we come to the division of the trust, the safeguards consist in the division of the trust funds in the portions. So before the division takes place, the investments are revalued in order to determine the total value of the funds as at the date of division. So any investment which are acquired or retained under specific power in the will or settlement are designated as special range property. And they are quite separate. They are kept separate from the other investments. So the remainder of the property is divided into two equal parts: fixed interest and the wider range. So when we talk of the fixed interest part of the trust, it contains now the fixed interest securities only, and we'll be looking at them shortly. Then we'll be looking at the wider range part of the fund, which contains either the fixed interest or the wider range investment. So when special range property is realized or sold, the proceeds must be invested equally in fixed interest and wider range security. And I'll be showing this in our pro forma accounts. So you'll be seeing that once we've taken care of the special range investment in a detailed manner, what remains now is shared equitably between now the fixed interest, and we can see here, you can see what is happening is it's a contra entry. So the transfer of the special range realization proceeds, we are seeing it is 700. So whatever remains, all these 700, our contra is supposed now to share this equitably between the fixed rate and between the fixed interest rates and the wider range. And that's what is happening down here. So you can see we are splitting them now into 350, 350. And when we add, we get now the 700, which now closes our contra in the estate capital account. So what I was saying is, all the classification, when we are talking of the fixed interest securities, we are talking of the securities either in the ones that are listed in the Kenyan government portfolio. We could be having the treasury bills, the fixed interest securities guaranteed by Kenyan government, the fixed interest securities quoted at the Nairobi Securities Exchange, issued by a company incorporated in Kenya, and they have a paid up capital of not less than 10 million shillings. So kindly note that, which has paid dividend in each of the preceding 5 years. Why 5 years? We really want our trust not to be exposed to what we are calling the excessive losses. And the only way is to ensure that we are investing in a portfolio that has show cost. The performance was positive in the last 5 years. Then fixed interest securities issued by Kenya Railways or the Industrial Development Bank, IDB, local authority loans, a deposit by the, whether fixed or otherwise, to Kenya Post Office Savings Bank, and mortgages on freehold, or what we call the free simple property, or leasehold property having not less than 40 years expired. The reason why we are doing this is to ensure that we cushion the beneficiaries against any excessive loss that is unforeseen. That's why we are making sure that, the best customer is the government. You never lose your money. It might overstay, but the government will ultimately pay as opposed to the private sector. So when we are talking of the fixed interest securities, we are dedicating our portfolio to what is what is popular to the government. Then the wide range investment has the quoted shares of a Kenyan company, and we are specific. We are talking of Kenyan because we don't want to start chasing for dividends in a company that is foreign. What is within our territory can be followed. And we've said that there is a requirement. These companies must have a paid up capital of up to 10 million Kenya shillings, and they have indicated or they have paid their dividends to their shareholders for the previous 5 years. Then shares in the approved building societies. Again, we want to be very sure, you know, that people are making a lot of money in the name of land buying companies. And these momentarily convert into what we call the pyramid schemes. And because we don't want the beneficiary to lose, we really want to be trustees. We are behaving like the owner. The way you won't want to lose your property, that's how we are supposed to administer the property of a trust. And then the unit issued by authorized unit trusts. So we'll be talking of the portfolio of the unit trusts that are well known. For example, if we look at the old mutual UAP, we know that they've been in existence for the past 100 years. We can rely on their analysis. So the cost of the unit trust, we know that it's stable and it is worth a wider range investment for our portfolio. So when we'll be dealing with the changes in the trust, profits or losses on disposal of investment should be treated as belonging to the part of the fund out of which they accrued. You said our Kenyan system adopts what we call the accrual basis. So the compensating entries must be made to restore the original status quo if the proceeds of the fixed interest investment are reinvested in wide range investment or vice versa. We should put that at the back of our mind. And then the property taken out of the trust may be taken from either part without any necessity for compensating entries. So you said where the trustee has what we call the power of postponement, or they have an authorized power, they can go ahead and invest because they are the fiduciary officer. We need to be very keen on the property taken out of the trust. So what should be noted is that the only time at which the narrower and wider range parts will increasingly be equal is when the funds are first divided into two halves. If they were not divided into two halves, this will not be possible. So kindly note that. I said our presentation will be more or less, it's like we are producing as a matter of form. That's why I'm talking of pro forma. So when I talk of the pro forma balance sheet, and this is merely for illustration purposes, we can see what is happening here. For example, we have the fixed interest investment detailed, and they are totaling to 2,120,000. We have some cash at bank of 900. So this totals to that. Then in the wider range investment, we got the detail is 5,450,000. The cash at bank for the wider range investment is 550. For the special range, we have 500. And the cash at bank that is reflecting as income is 30,000. So in our estate capital account, our fixed interest rate is giving us the 3,020,000. This is what is reflecting here. Wider range is what is reflecting down here, the 6,000. You can see this is a matter of contra. And then the special range is what is reflecting here. And then now we've indicated our estate income as 30. So the total, or what is in the balance sheet, is actually, you can see, is a matter of presentation. That's why we are talking of the pro forma. We are talking of the pro forma. So when we go to the estate capital account again, you can see the contra. So you can see what is happening. We have a contra for transfer of special range on the realization proceeds, and this was equally to the fixed and the wider range. So you can see this is specified. So we know the special takes 700. So we expect that our contra will divide the fixed interest and the wider range into halves. 700 divided by 2 is 350, 350. So as a matter of fact, this is what is illustrated here. What remains here is a matter of illustration, and this is just demonstrative. So when we come to the pro forma estate cash book, we can see what is happening. We had a balance brought forward of 100, 250, and what is happening is we got a payment that was made to the life tenant of 620. What is supposed to be of our concern is what is coming from the investment account. So you can see what is happening. We have the 350, the contract that we made in the accounts. And when we look at the balances, something that I needed to illustrate down here should be illustrated. So we need to know the revaluation of the investment in order to ascertain or what is attributable to the beneficiary. And this is the item that will be coming now from either the trust deed or the will. So we'll be given how the interest are supposed to be shared amongst the beneficiaries. And these beneficiaries could be minors. And that's why we are looking at the accumulation accounts for minors. And we know that a minor is someone who has not attained majority years. So the income accumulation, when the property is left in trust for minors, the income earned for the period is divided equally according to the terms of the will or the trust deed. So the settlor will say, to my son A, B, and C, share my property in equal shares. So if the property was worth 6 million, we expect that each of the sons or each of the minors will get 2 million, 2 million, 2 million. Then we have what we call the maintenance payment. In some instances, we find that the trustee is given even the power of taking care of the schooling, the daily upkeep, etc. So there is that amount that is coming from the trust account to support the minor. So according to the Trust Act, this will be debited in the respective income accumulation accounts. If there are any investments of accumulated income, we expect that the accumulated income from the time to time will be earmarked or will be shown in the accumulation account, and what is accumulated and investment should be credited in the income accumulation accounts. And this should be divided according to what is appearing either in the trust deed or the will. So it will be appreciated from the above that the income accumulation account is merely an income account ruled with columns to distinguish now what belongs to which beneficiary. So the total balances on this account will be represented by accumulation, investment, and cash at bank. So the distribution will be done, or before the distribution to the beneficiary, investment will be revalued. And we are revaluing them because you remember you said that initially they came, or they were, to state the status quo, they were brought in at probate value. Probate value being the value at the time of death. But this will now, we expect that whatever will transact henceforth will be either at on cost, if they were properties that were purchased, they'll be reflecting the historical cost, and any other investment will be stated at the prevailing market rate. So the reason why we are doing this, we need to do the revaluation to establish whether it is a profit or it is a loss that we incurred. So we expect that this will be appearing as either the capital investment, which will be shared according to the trust deed or the will, whichever comes first, or the accumulation investment. If now the trustee goes ahead and invest as we wait for the minor to attain the majority years. So accumulation account, as at the commencement of the year, we expect that the beneficiary will be paid the share due to him in either exact division of each investment or appropriation in specie. And when we talk of the appropriation in specie, this term in specie, it describes the transfer of the assets in its current form. So when we are talking of the appropriation in specie by agreement and adjusting either way in cash, we are talking of, or we are describing the transfer of that asset in their current form, rather than the equivalent amount of cash it could fetch. Of course, all investments that were realized and the amount due to the beneficiary is paid to him. It should be reflecting in the accumulated accounts. So when you are talking of the accounts of the minors or the accumulated accounts of the minor, this is what is expected. You can see we have a pro forma estate account. The beneficiaries, there are three. We have A, B, and C. So these are the beneficiaries. Sorry for that. So these are the beneficiaries. So we are talking of the distribution account, or when we now transfer the amount due to this beneficiary. Let's say A is the first one to attain the majority years, but B and C are still minors. So we cannot hold A interest until B and C become of age. So you can see what is happening. On the credit hand side of the capital account, you can see the profit on revaluation after we revalue is, we had a balance brought forward. Now these are the probate value. It was at 2 million, 2 million, 2 million each. They are sharing equally. But after we did a revaluation, there was realized a profit of 200,000 in each beneficiary. So as at the end of the period, each of the beneficiary is commanding a 2.2 million. So when A attains the majority years, they become adults, we are going to give what belongs to them. But we are going to retain the minors B and C until they become of age. So in our pro forma income accumulation account, you can see what is happening. So you can see we have the maintenance payments, what was maintaining the beneficiaries, maybe school fees, food, daily upkeep, if they were paying rent, etc. But when we are closing now for the beneficiary A, we need to know the balance due. You can see the balance due for A is 190, and because they've become of age, we need to close that. So if you look down there, the year total is accumulating to 230 for A and for B, but for C it is at 165. Now this of course will be guided by what is appearing in the trust deed or in the trust document. But most importantly, look at the investment on capital. The income received on capital investment is divided in equal proportion. Yeah, and this is according to the trust deed. So you can see each and everyone is getting 100,000, 100,000, 100,000. So the investment on the accumulation account is received in this particular manner as at the beginning of the year. Beneficiary A got 10, beneficiary B got 10, beneficiary C got 5. So investment on the accumulated accounts will also be reflecting that. So you can see on revaluation, after we revalue, it is like reflective. 10 got 20. So we expect also, A got 20. So we expect also B, who was equally getting 10 in the share, will also get 20. But C, who was getting 5, is commanding now 10. This is a matter of illustration. When we come now to distributing this, you can see what is happening. We have the balance due. The balance due to beneficiary A is supposed to be paid because we are clearing them out. So in the distribution account, we are only reflecting those who have attained the majority years, and this is A. So we'll give the year stake after revaluation, which was 2 million. You can see it was 2,200,000. So this is what is shareable. And then we had in the distribution account, we are reflecting that the balance that was due to A, because we are adopting what we are calling the accrual basis accounting. So this is what will be, or what is reflecting down there. So the yearbooks of account, we expect that the balance due as at the time of distribution will be 190,000. So if we add that to what they are commanding, the books or the pro forma distribution account will be totaling at 2,390,000. And then in the balance sheet, we expect that everything that remains will be appearing in the detailed accounts, which is the balance sheet. And this will be 2.2, 2.2 for B and C, and that is giving us the 450. Then we have the cash on accumulated account, and this is of course over time and is a detailed 350 because of either the dividends or the incomes that we are accumulating in the income account. So that's totaling to that amount. So in the estate account, we expect it to balance because it will be shared between now B and C. So if you look at the portal, I've given an example, and this is an example of an exam question, how it may appear. I want us to attempt, and then we will do it together to see how or what was expected of us. So I expect us to go and now interact in the portal. And without further ado, I'll want to end this here and wish you a brighter Monday. Thank you.